go time.
Good morning. Welcome to the Next Level Mortgaging Podcast. I'm your host, Todd Martin from Mission 35 Mortgages. What are we going to talk about this week? Let's talk about down payment and debt payout. It's going to be a little bit of a learning one this week. What weighs more and what is more useful when it comes to purchasing your house, first-time home buyers, anything along those lines. So the way a mortgage calculation works, the way an application works, there are two main calculations. There's your gross debt service ratio and your total debt service ratio. I know, boring topics. Basically what it means is it takes once you apply for mortgage and your mortgage is included into your what your future mortgage will be, it will include it into all of your current debts. And it will take into account your income, and as long as you stay under the numbers 44%, 39%, you're usually fine. So they basically want to make sure that you're not overstretching your income, that your debts that you have aren't going to overstretch the income that you're bringing in. As long as you can do that, most of the time you're fine getting a mortgage. So how do you stay under those numbers? A lot of people always think about the down payment. How do I get to that 20%? How do I get to that 5%, that 10%, whatever? You get under 20%, you get an uninsured mortgage, you don't have to pay the insurance on it. Everybody thinks, well, why do I pay a higher percentage at that point? It's because as soon as you go over that 80%, the mortgage lending company is automatically going to insure the mortgage to cover their own ass, and you're going to pay for it. So, you get $20,000 added on your mortgage. So while you're paying a lower rate, you're paying for more when it's all said and done. So while you have a higher rate for putting more down, because it's not insured, you're going to end up paying less in the long run. But beyond that, so your numbers are tight. You're 43.8, you're 44.2, whatever, something along those lines. You're 30, instead of 39, you're at 41. How do we make the numbers work? How do we make them better? Are you better off to add more to your down payment, or are you better off to pay off your debt? And the answer almost always surprises people. You're much better. It's way heavier. Your debt is way heavier than what you bring in. So if you can bring down your debt, it will drop the numbers faster. You are much better off to bring down $15,000 worth of debt and put an extra $50,000 into your mortgage, into your down payment. It will make a much bigger difference in your numbers, and you can have money. You can save money for repairs. You can save money for other issues with the house, anything like that. You can put that money onto the mortgage later if you want to, because most mortgages let you put up to 15%, sometimes more, on an annual basis. So, if you have concerns about the house, you have concerns about, you want to do some cosmetic repairs, so you want to back out some of that mortgage, you want to hold on to some of that money, pay off the debt first, right? And that will bring the numbers down faster. And once you bring down those numbers, so it doesn't, say you're at 87% on your loan to value, so you're at a 900, just because the numbers work easy, you're at a $990,000 house, and you're putting down $130,000, and puts you at $860,000 mortgage, and that basically is 87%. It's like 86.5%. Right. And those are great numbers. Those are good numbers to work with because you have some wiggle room, but your GDS and TDS are a little tight. You're sitting at 46% on your TDS. You're sitting at, 40% maybe on your GDS, or your GDS is fine, but your TDS is just too high. And you have to bring them down. The banks aren't going to look at them. They aren't going to say yes. The A lenders are going to say yes, because that is just a little bit too high. So what can you do? Yes, you can put down more money, but you're going to have to put a lot more money to bring down that 2%. Instead, say you have a $7,000 credit card, pay that off. You got a $15,000 on a car loan. You don't have to pay it all off, but pay a chunk of it off, right? And you will see those numbers drop down dramatically. I just had a client that I was working with. We were trying to make numbers work so that they could keep some money out to do some home repairs. and still be able to afford the house they wanted to buy. So how do we make it work? And surprisingly, I was able to pay out $17,000 worth of debt they had and back out $37,500 worth of down payment. You know, they were able to keep that money to do the repairs they had to do on the house, and you know, and still maintain the I think they were at 93% on their LTV, and it brought the GDS and TDS. It brought the GDS and TDS down to 43% and 34% off the top of my head. So the numbers worked. Paying off debt is such a huge weighting factor when it comes to purchasing a house, because the bank is going to take those numbers, that credit card debt, that line of credit, that car payment, and they're going to take a certain percentage of it and they're going to weight it into your GDS every time, right? And that down payment you put on makes such a small dent into what the entirety of your mortgage is going to be in the long run. So you're much better off to drop that debt load down, so that the GDS becomes smaller. Because if you're paying, $2,400 a month in your mortgage, you're paying, $200 a month in credit card debt, $300, $400, $500 a month in car payments, and $400 in a loan payment for HELOC or a line of credit, and all that stuff adds up. If you can take those down, and all of a sudden all you're doing is paying $2,400 in a month in your mortgage payment, it makes such a huge difference. And that is just something I wanted to bring to attention, because it's something that I have noticed a lot in the last couple of months of the stuff I've done, that the weight that the debt load carries is so much more significant than the down payment. Yes, the down payment is necessary. You need it. You got to get there. But if you can get that 5% and pay off your debt, you're going to be in a much better position to handle it. And you're going to be in a much better position to get the mortgage you want than you are if you just come in with a down payment. And one small thing, we talked about something today in one of my courses. When you have a down payment, you got to remember, it's not just a down payment you have to prove that you have. You have to have your closing costs. You have to, and that's a separate entity from just your down payment. So, if you're a first-time home buyer, if you're a high ratio, you're looking at 1.5% of whatever the closing costs, whatever the purchase price of your house is. If you're buying a $500,000 house, then you're looking at like $7,500 in closing costs. If you're going higher, if you're going conventional, you're looking at about 2% closing costs. So you have to keep that in mind. So you need those costs on top of everything else, and you need to be able to prove that you have the funds. And all of those funds you have, unless you're getting gifted, you have to be able to prove stability of the funds for 90 days. So those are all things to keep in mind when you're putting together down payments, when you're putting together what you want to do when you're buying a house, whether you're a first-time home buyer or a seasoned buyer. There are little things that make things a little bit easier in the long run. So just a small piece of information for you guys going forward. Little thing. Have a good weekend. Enjoy your time. I'll be back next week. See you later, guys. Don't forget to like and subscribe.